The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast. If you're enjoying these podcasts or find them informational, please feel free to forward them on to your friends and family, coworkers. Help us spread these out a little bit. Thank you very much. We appreciate that.
Today we're talking about target date funds. That's pretty much a standard component of almost every 401k plan in the country. And there's a reason why. There has to be a reason why. And these were not popular. I'm not even sure they were in existence prior to the great financial collapse in 08 and 09.
Yeah.
It really came into the forefront there because as the markets hit their bottom in March of 09, virtually nobody wanted to be in the market. And brokerage firms were just scrambling. What do we do? All this money's in cash. People don't want to invest. They're afraid that this is going to be worse than the tech bubble. We have to do something. If we're going to sell something, we have to sell them investments if we're going to stay in business. That's the reason Wall Street firms exist, is to sell investments to the public. And 401ks are a huge amount of the pool of money that wasn't going into stocks. And if it's not going into investments, Wall Street doesn't make very much. So the target date fund concept was, you're scared, you don't know what to do, but we're the pros, we do. We've created this panacea for the rest of your investment lifetime. If you're young, we'll invest aggressively. As you get older, we will make it consistently less aggressive. That sounds like a great concept. So you just pick a year that is close to your retirement date. Maybe it was 10 years ago, maybe it was 2030.
Sure.
Maybe it was 2055. Might have been 2065 if you're much younger. But the theory is that you pick that target date of your retirement and all your worries go away because Wall Street will manage the fund and you can sleep. As we say in our webinars, investing is not for sluggards. I mean, you got to pay attention. But this is a product for sluggards. You don't have to pay attention because Wall Street knows what they are doing.
And believe me, anytime Wall Street tells you you don't have to pay attention, that's when you should be paying attention. Because if you take a look at their concept, none of this has to do with anything going on in the market. It's only got to do with how old you are and when you want to retire. That's it. How's the market doing right now? Doesn't matter. You know, the older you get, we're going to load you up with bonds. Are bonds a good place to be right now? Doesn't matter. That's what's going to happen. So it's got nothing to do with the market. It's got nothing to do with the investment you're holding. It's got to do with a very broad-based asset allocation model based entirely on your age and when you say you want to retire. And those are two things that should almost be not part of your decision-making process for investing. You need to be looking at what's going on in the market, not what's going on, which birthday you're on. And that's just not that important.
Well, you just mentioned the bond allocation. So virtually everybody gets a bond allocation because you're supposed to own bonds. We're not quite sure why, but everybody's supposed to own some. That's what the rules say. And under ERISA, the Employees Retirement Income Security Act of 74, had to get all those letters straight.
There you go.
We just refer to it as ERISA, forget what it stands for. But under ERISA, which came out of the collapse of the market in the 1969 bear market, and of course we're dealing with the 74 bear market. And so ERISA came out and said, we need some standards here for retirement plans to operate in a responsible manner. Because prior to that, a lot of retirement plans were just a tax-sheltered pool of money for the owners. And anytime an employee got close to retirement, they fired him because the vesting benefits were virtually nil.
Perfect.
Congress finally waked up and said, this just isn't quite right. So we have ERISA. ERISA says you've got to have diversified choices. You have to have a multitude of choices, and they need to cover a multitude of asset classes in order to be properly diversified. And so most of the time, people just simply got a menu of mutual funds, and the average employee has no clue about which mutual fund is the right one to invest in.
Right.
So they would chase performance, and at market bottoms, they would panic and they would get out, and they wouldn't get back in until the top of the next bull market. That wasn't working. So the target date fund was theoretically the way we're going to address this issue because the professionals are in charge. Well, the professionals are also charging. That's one of the problems with target date funds. Now, we manage corporate 401k plans at this time for local employers, and that's where our marketplace is. We can do this nationally. It doesn't matter to us what state you're located in. And we include target date funds in the menu of choices. So if you want to use one, that's fine. But when we took over these plans from prior operators, we found Fidelity and BlackRock were the primary target date fund choices. And if you go look at Fidelity's target date funds and compare them to what we use, which are Schwab's target date funds, the broad market, like the S&P 500, a broad market fund of Fidelity can charge as much as 0.75%, or what's called 75 basis points per year.
Right.
For a fund that basically is a statically invested fund. I mean, there's no active management. They periodically rebalance targets, but broad asset diversification targets, not based on what's going on in the market. To get a similar fund at Schwab is 3 basis points. The difference is 3 to 75.
That's
That's
huge.
money
Yeah.
that's coming out of employees' pockets that's hidden. Well, once we figured that out, you said, well, this makes no sense. Here's a benefit for the employees and for the plan. Part of the trustee's responsibility is control costs. That was an easy, quick cost reduction in the 401k operation. But there's another issue, which is diversification. So in a target date fund, the theory is the older you get more bonds. You just referenced that a minute ago, Perry. But look
Sure.
what's happened in our bond market over the last 4 years. We've had a bear market in bonds. So the older you get, the more money goes into a bond portfolio or the bond portion of your portfolio, which has been losing money for 4 years. Well, that's not as bad as losing money for 3 years in the stock market. If we go back to the 2000 tech bubble, it took almost 3 years for that to turn around and bounce off the bottom.
Sure.
But here we are, your conservative investment fund, the bond side, is in a 4-year bear market. And as we move into 2025, the question is, what's the Fed going to do? It looks like inflation is rising. Will they really be able to cut interest rates, or will they have to raise inflation rates or interest rates
Right.
in order to slow down a resurgence of inflation? And when they do that, they contribute to inflation. This is a real conundrum. This is the old adage that they've painted themselves into a corner and there's no door to get out.
But that's still going to affect your fund, and that's the problem. The problem is they're making adjustments in your 401k fund based on 40 to 80 year averages. Meanwhile, if you're in retirement, that's money you're spending today. And the fact that you're losing money for 4 consecutive years is of no concern to whoever put that allocation in there, because over 50 years, it's going to be fine. You don't have 50 years anymore, but they do not shorten up that window based on your age. They still put it in there, the allocation, based on a long-term average of an asset class, which is absolutely meaningless to your returns in your account now, because you're retired now. You don't have a lifetime to make that money again after you incur those losses. So it vastly increases the risk of you running out of money prior to you running out of time in retirement. So that's one of the people's primary concerns, running out of money first, and it's just not addressed. It's ignored, in fact. Like I said earlier, that allocation is based on your age. It's got nothing to do with what's going on in the market. We just don't think that's good enough for people's returns, especially in retirement. That's when you need to be sensitive to what is actually happening to the dollars in someone's account and not the 50-year average return of any asset class.
Well, you mentioned dollars in somebody's account. The other issue related to that is the US dollar, because under the broad diversification of modern portfolio theory, you are always exposed to foreign assets, to foreign markets
Yep.
all the time. Now, you turn around and take a look at some of these plans, and we're using Fidelity in our reference here. We look up that, and we find as much as 45% at certain ages allocated to international markets. But where has the return been coming from over the last decade? It's been in the US market. There's been hard to find, except for brief periods, which would be okay to be an international, but to be permanently allocated to a high portion of international investments without regard to, are they doing well? Are they contributing to my economic health? Or are they a detriment? Well, eventually they will probably become dominant again. Japan in the 90s, actually Japan was not doing well. We go through periods of time where we get international that does well, usually with a weak US dollar. And then when the dollar gets strong, international stocks they've lost the wind in their sails and they are just muddling along. If you're lucky, you may get a little bit of a positive return, but more than likely you just simply get increased risk. So is there a reason for using these? Well, yes, the primary reason is trustees have them to avoid personal liability, because if they provide them as a choice and you don't use them, you made your own choice to not use an ERISA approved investment concept.
Correct.
Now, should you never use them? No, we don't believe that. We have them in our menu for the funds, for the employee funds that we manage, but we only use them in our investment models when they're providing performance. If they're providing better performance as a diversified approach to the market than making specific investments in growth or value or dividends or a foreign stock, then we use the target date funds in the model. We treat them like any other fund. Are you doing something beneficial for me in the current market? If so, I want to own some of you. If not, you come out of the portfolio because I'm going to own something that is actually helping me at the present time under current market conditions.
Yep.
So it's kind of what's at the top of the list. If
it's
you're
important to remember
and adding to my financial welfare, hey, I'm all in.
There's no regulation in target date funds. So if you change fund companies because your 401k plan moves, the 2050 plan at one company has got nothing to do with what might be in the fund at a 2050 target dated plan at a different fund company. They can put anything they want in there, which is why sometimes they do well and sometimes they don't, but they expect you just to stay because it makes it an easy one-stop shop for you. You just pick your retirement year and then forget about it, which is what they're hoping you're going to do. But that gives them the ability to actually put anything in there they want, and without regard for, is this the best thing for you at that time? So it's if you're going to use a target date fund, it's really even more important to watch out for what's in there, because there's no rules about what should or shouldn't be in those target date funds. They can put anything in there they want.
Well, the other major issue is at retirement. Some target date funds have a strong allocation to bonds as people move into the retirement years, irrespective of actually what's happening in the market. Others say, well, you're going to have a long life, and bonds don't provide the return over long periods of time. So if you're if you're going to be living into your 90s, you shouldn't have bonds in your portfolio. You should have a lot of stocks, which means that you're going to get a lot more volatility and risk in there. Just exactly how do you resolve this? We resolve it in the same way we manage money for individuals, and we manage the models for the 401k. We watch for what is performing in the current market. If it's not performing, it comes out of the model. When it comes back into performance and the market favors that particular asset class or that particular fund, it comes back in the model. So we're using low cost funds to adapt to a dynamic market. And if you think that's easy, this year is probably going to be one of increasing volatility as we deal with the implementation of President Trump's new policies. He's bringing on tariffs. He wants tax cuts. He wants less regulation. This is something that the market and international markets haven't quite figured out how to deal with. Whether or not Congress is going to do that and to comply with his requests. And we have the Fed who's stuck in a box because of rising inflation and their need to cut interest rates so the mortgage market can work more readily, more efficiently than it is right now. All of these factors are going to create volatility this year, and just simply buying a target date fund and saying it'll all work out in the end is a choice. It's just not one we'd recommend. If this information is helpful to you, or you think any of your friends, family, or neighbors, co-workers would benefit from it, pass the link on to them. Subscribe to our podcast with the link that's down below, and join us for our next one. Thanks for being with us today.